Today I'm taking a look at Currys, just known as PC World, many years ago Dixon Store Group, and a variety of little names of their trading brands over the years, but it's now all back to Currys as under the one big umbrella. So Currys is an electrical retailer, so it's televisions, washing machines, vacuum cleaners, fridges, freezers, coffee machines, even iPhones in store as well, Fitbit, look at that, all sorts of things going on there. So it's a very, very diverse retailer, all under one roof. But things have not been going quite as well as things would maybe appear. So we're going to take a little look. Now, electrical retailing for me seems to have changed quite a bit over the years. Years ago, we used to see Comets and Powerhouse and quite a few other smaller independent retailers around in the market, and it used to be extremely competitive. Now, I'm sure Currys management will say, well, yeah, it's still a very competitive market, and we're competing with online retailers. We've got Argos, we've got John Lewis, we've got every man and his dog also out selling electrical appliances. So there's still a lot of competition, but the competitors have maybe changed a little bit. It's also changed in terms of the market, because you go into a Currys store now, and the days of the old electrical retailing where they had a lot of much more, I would call them salespeople in the store, who were targeted very heavily on selling extended warranties at exorbitant prices. And although they're still doing the very high financed APRs at 24.9% there with the buy now, pay whenever, those sort of deals are still there. A lot of the approach in Currys PC World has changed in the last few years, when they're just seen as more like a showroom for people to come in, and people are not being pressured to buy anything or pushed or encouraged in any way, and in fact in many cases just directed back to the Currys website to go place their order online, which I'm not really sure is having a really good effect on the figures. So let's go have a look. So the figures here are based on up to April 2022, so we haven't seen the rest of the 2022 figures, although the stores have looked fairly busy. Certainly my local one has, with a nice steady trade of customers in there, and quite a good number of staff as well, but whether the staff actually approach you anymore is a different story. So turnover has stayed actually very, very consistent over the last few years. Even through the rainy Rona, the online sales were still doing very well, and the gross profits look pretty consistent there. So we've got like $1 billion turnover, and we're running about an 18% or so gross margin. But net profit is the one that is the important thing, and that sits very, very low. So they're relying on massive turnover to try and generate some profit. 2020, 2021 were very, very poor years. 2022, which will the end of most of 2021 featured in that figure, a small little profit there at the end of the time. But in past years before that, we're looking at really, really low profit margins. So it's got a very much tighter market. It does make you think, as a business, they might need to change their focus a little bit and maybe go back to a bit of, let's put salespeople in the store who can sell things. Maybe they're working in departments, so they're specialising in televisions or specialising in washing machines. I was looking at washer dryers recently, and they've shot up in price because they're all selling very expensive, low energy ones. But there's no one there to really sort of explain to you why, and you do need a salesperson to do that. So assets versus liabilities, again, that's sort of stayed fairly consistent. The liabilities have actually come down over the last little while, which is better news, but it's still pretty hefty. Capital expenditure, I would say that's looking fairly consistent. I don't think there's massive growth on here. Yahoo Finance is talking about a 2% annual growth. When we've got an inflation rate over 10%, that's probably not a good figure. And free cash flow, that's down on the year up to April 2022. So it'll be interesting to see what next year's figures are like. But the fact that the share price has hit pretty much a low figure at 54 pence a share at the current time, it's not an encouraging sign. So I don't think the analysts are expecting good news here for the next year's figures. The free cash flow calculator there is coming up with a zero figure. That's a bit of a worry. The Phil Town figure, which is the 10% one. So Phil Town's 10 cap method is putting it at 58%, which is one of the biggest figures I've seen, which is like a serious buy. But you've got to weigh up so many factors in making a decision whether to invest in the business or not. So let's take a look at SharePad. The price over the last 3 years, we seem to be really back down below the lows of when Rona hit, and we're below that figure, and the thing is heading downwards, which is not a great sign. So there's a nice big peak up there, and it's just sort of been sliding and sliding and sliding. Bit of a bounce back, sliding again. That may well be just the overall market as well, but if the figures in April aren't good, that figure may go a lot lower. So it's an interesting one, and it's a very tough market. And I think that's maybe where a business needs to sit and have a rethink very seriously about how they're running their business and their approach to the customers in the market. And I think it may come back to good old-fashioned service. The days of, we will deliver your television for you, we'll install it and set it up for you, we'll deliver and set up your washing machine, we'll take the old appliances away for you, and that's all part of the service. And really look at maybe the ongoing service revenue, because if the profit margin in the product itself is relatively low, you've got to have that ongoing rolling revenue out of something, and service may be the one big factor, what's in the repairing side, etc. But things don't again go wrong as they used to do. So yeah, it's a difficult one to decide on. So simply Wall Street's putting the fair value with their calculator there at undervalued, with a current price that was 54 pence, but at 61 as their fair value. So it is undervalued, but I get the feeling that price may slide a little bit lower. So we'll have to see what happens over the next year or so. That's just my feeling on it and my opinion. And whether you buy something or don't, it's up to you. So do feel free to share your comments in the comment section below. Today's video is sponsored by Rule Number 1 by Phil Town. It's a lovely, easy read, and one of the first books I read getting involved in investing. It shows some lovely, easy ways to calculate the true value of a business and work out what sort of price you'd be looking at to buy a business when it's on sale as the ideal time. So you can click on the Amazon link in the description below, and for $8.99 you can get yourself some great, easy reading. There's a good way to get started in investing. And clicking on the link also helps support the channel, of course. So if you like the videos, do like, comment and subscribe, and we'll catch up with you again soon.